I don't get it. The Fed fund rate is going down, but my mortgage is going up. What's the deal? Stay tuned, I'll tell you why. Hey everybody, Greg Barron, professor of real estate, and today I'm going to try to tell you why there's this phenomena. You're seeing Fed fund rates go down after they've climbed 11 times. Now they're reducing, but my mortgage rates have not gone down. As a matter of fact, they're going up lately. So what is that phenomena, and why is it affecting my mortgage rate? Well, first off, you have to have a basic understanding of what the Fed does anyway. It's a very complicated mix, and as a matter of fact, I think sometimes that they don't even want to tell you why. They don't want to tell you the complications, and they make it difficult so you won't understand it. It's a basic, trust me, we're the government. But here's the basic reason that your rates are still going up. So since September, the Fed has lowered the rates twice, basically 75 basis points. And you have to remember, that's after 11 incremental increases. So it's lowered just a little bit, but every time I look over at the mortgage rates, it starts to climb. And this next graph I'm going to pull up, it's going to show you the incremental increase in mortgage rates over the last couple of months. What you'll see is this relational effect of Treasury yields that go up and mortgage rates that go up, but Fed fund rates are going down. Well, number one, the Fed has no control over long-term interest rates, and here's the reason why. Long-term interest rates are primarily driven by a yield or return on investment that investors want for investing into the bond market. So if you look at the graph as today on a 10-year Treasury, the yield is 4.41%. And you can also see how it's spiked up recently. As the yield continues to go up, that has an inverse relationship on the amount of demand that there is. Well, think of it this way. If investors aren't buying bonds, what's the government going to do if they need to sell bonds? They need to raise the yield. So when they raise the yield, it gets to a point where investors, and mainly institutional pension funds and agencies like that, will say, that's what it's going to take for me to invest in this 10-year Treasury. Now, mortgage rates are not tied to the Fed fund rate like a lot of people think. And that's one of those things I think the government really wants you to think it does, but it has nothing to do with the Fed fund rate. The Fed fund rate is really an interbank lending mechanism, has nothing to do with long-term interest rates. Long-term interest rates are tied to treasuries, and specifically 10-year treasuries for long-term mortgages. So if the treasury yield right now is 4.41, the long-term interest rates for, say, a 30-year mortgage are usually going to be 1.5% to 2% higher than that. So to repeat myself, if the government is trying to sell bonds to satisfy debt, to stimulate purchasing of those bonds, and nobody's buying them, they have to raise the yield or the interest rate on them to get you to purchase them. When that yield goes down, that means there's a higher demand for them, and money is flowing back into these bonds for various reasons, and that's another conversation. But right now we're seeing yields continue to rise because the government is having to pay more of a premium for those longer-term investors to buy them. So the 30-year mortgage-backed securities are tied to the 10-year yield or the 10-year bond. And remember, 1.5% to 2% higher than 4.41 is 6.5 plus. So now as I put the graph back up for a 30-year mortgage, you'll see that the current rate is 6.84% when the treasury is 4.41. That's a little bit over 2% spread. That's the premium that these long-term lenders want above the 10-year treasury to lend you money. So you have a lot of disconnect as to what it really means and a lot of confusion out there. I hear a lot of investors saying, wait a minute, we've got great optimism because the Fed fund rate is being lowered. Well, the Fed fund rate really only affects short-term borrowing. ARMs, credit cards, car loans, those things that are shorter term duration. But your longer term mortgages are tied to a 10-year treasury and a 10-year yield. So some of you may ask, well, why is the yield higher right now on these bonds that they're trying to sell? It gets a little more complicated then, but one of the simple answers is that the expectations of inflation are going to erode the purchasing power of that bond. So those investors require a higher yield. So if the expectation of inflation is going to go up, that means that I want a little more for my money, because 10 years from now, the purchasing power of the same dollar today, 10 years from now, is going to be much less. Therefore, I want a bigger premium. So the primary driver of this disparity between the Fed fund rate and the long-term yield, or an inversion, is the simple fact today, in my opinion, that the investors, the smart ones that are buying these bonds for long term, they don't trust the Fed right now. They feel that inflation is going to come back, and they want a premium for buying those bonds. So here's another psychological factor that I think is playing into the fact that this inversion is still happening and you're still having this disparity. Because basically everybody wants their interest rates to go down. I mean, long-term lenders want their interest rates to go down. Home builders want that interest rate to go down. But in the same effect, this last election, there was a lot of pent-up optimism that came out of it, and I can speak for that because even in one of our companies, it's usually directly related to interest rate and to optimism in the market in the real estate sector. We're kind of a canary in the mine. And we just got slammed right after the election. We had all these projects that were pent up that our client developers all of a sudden pushed back into the pipeline. But the rates still aren't going down. Well, again, the reason the rates aren't going down yet is because the government is out there trying to sell these bonds and nobody wants them right now. There was just a recent auction of 20-year bonds and nobody wanted to buy them. So what happens? The government wants to entice you to buy them, so they raise the yields on them. Well, the yields are basically a function of the supply and demand. The yields have to rise to get investors to get back into that market. Now remember, the bond market is infinitely larger than the stock market. Infinitely larger than the stock market. And another reason that there's a declining demand where yields have to increase is that there's a heightened sense of optimism in the economy. Now again, this happened right after the election. So you're going to still see this incremental increase in yield because demand is going down because there's optimism in the economy. And it's a known fact that in stronger economies, investors seek larger returns, i.e. the stock market, and that's why you've seen the NASDAQ and the Dow continue to rise. So as the bond market needs to sell bonds, they've got to continue to raise them. Number one, because nobody wants them right now. And two, because there are other investment vehicles out there that investors feel confident to go into. So in summary, I hope this is not too confusing, but the main thing that you need to remember is Fed fund rate does not necessarily control long-term interest rate. The Feds do not control long-term interest rate like a lot of people think. So don't anchor into that. The bond market controls the long-term interest rate, and usually there's a premium above the yield, and that's where long-term mortgage rates are tied to. And also the second thing I'll leave with you is the expectations of increased inflation usually make yields rise because investors think the purchasing power of a dollar today is not going to be what it will be 10 years from now. Thanks for joining me today. I know this is kind of heady stuff. Keep tuning into the channel. If you like it, be sure and like and subscribe. And as always, be sure and educate so you can evaluate and ultimately execute to increase your own personal wealth. We'll see you soon.